Now, I really want to introduce this concept to you primarily because it has really helped me gain a much clearer understanding about the underlying dynamics of the stock market, but also because there isn't a lot of material either in printed textbooks or online that illustrates this relationship between supply and demand and the stock market. And given the limited number of resources available, I've created my own economic model of supply and demand by improvising some of the characteristics, namely demand shifters and supply shifters, which we'll cover later in this video. Supply and demand is probably one of the most integral conventions of economics. Its application can be applied to a number of various fields such as business or farming. It can be used to reduce wait times in lines or managing the flow of traffic in toll lanes. But most importantly, supply and demand can be used as a functional mechanism to anticipate the outcome of securities within the financial market, as well as explain what is moving the stock price. And in fact, understanding the laws of supply and demand has enabled me to increase my probability of success not just in the stock market, but in the forex market, which involves the exchange of foreign currencies, as well as predicting the direction of crude oil, and even mastering the ability to predict the direction of gas prices at the gas pump with about a 90% accuracy. Now, I could dedicate an entire video of supply and demand, so I'm going to cover just the essentials for this video that describe the relationship between the stock market and supply and demand. An economist in the 1900s named Alfred Marshall is attributed to the development of the supply and demand graph that is usually depicted in most economic textbooks. Now, this graph, which is displayed in front of you, is representative of any market activity that can be demonstrated through the laws of supply and demand. Now, for example, using this chart, I can show you what happens to the price of orange juice if there is a shortage of oranges to produce orange juice. Or I can even demonstrate how a change in the number of vehicles in toll lanes will affect the price of the toll. And most importantly, I can also show you what happens to the price of a stock when direct or indirect circumstances influences the outcome of the company. Now, just to be clear, a market in its simplest form is a place where buyers and sellers meet to facilitate a transaction. In this example, buyers and sellers are exchanging shares of stock for money or money for shares of stock. I'm going to start with this simplified diagram of a supply and demand graph. Now, for this particular example, I'm going to use a hypothetical pharmaceutical company that trades its stock on the stock market. We'll call the company Pharma Corporation. And so this graph is going to represent the market activity, or more simply, the exchange of shares of stock available within the company between buyers and sellers. So the quantity down here, this horizontal axis, is going to be our x-axis, which is equal to the number of shares, 1,000 shares, 2,000 shares, and so on, which we'll call volume. The y-axis over here represents the price of the stock. A typical supply and demand chart will have two lines, as can be seen here. The upward sloping line is supply. Now, we can think of supply as the sellers, and the downward sloping line is demand, which is associated with buyers. But before we get into the technical aspect of supply, I'm going to focus on the characteristics of demand first. So what is demand? In layman's terms, demand for this example are the buyers in the stock market, and think of it as buyers who are demanding, quote unquote, demanding stock, okay? And demand tells us who is willing and able to buy various quantities of stock at various possible prices. And we can display this visually on the graph by drawing what is called a demand schedule, or more commonly, a demand curve. The reason we call it a demand schedule is because we can list each point on the line in a table or schedule. Remember those days when we had to plot points on a graph using x and y coordinates during algebra class? Well, this is the same concept, except we're graphing stock prices and quantities demanded. Here is your price column, and here is the quantity demanded column. In math class, the conventional method is to display the price on the x-axis and the quantity is displayed on the y-axis, but in economics, these two are reciprocated. The price is on the y-axis and the quantity or quantity demanded is on the x-axis. If we plot these points on the graph, we get a straight line, which is our demand curve. The demand curve tells us, again, who is willing and able to buy various quantities of stock at various possible prices. I had to repeat this because it is often confused with another economic term called quantity demanded. Now, quantity demanded is the quantity that buyers are willing to buy at a specific price at a specific period of time. In other words, the demand curve is the line, and quantity demanded is a specific point within that line. Before we go any further, I would like to explicate a critical element of this section, and that is the law of demand. The law of demand is a relatively easy concept to grasp if you haven't noticed it already. It is a negative or inverse relationship between price and quantity demanded, which states that, other things equal, as the price goes up, quantity demanded goes down, or when P goes down, quantity demanded goes up. We can see this in our demand schedule. As price increases, quantity demanded goes down, or as the price decreases, quantity demanded increases. So if the price of a frozen pizza is $5 per box, someone might be willing and able to buy 2 at that price. But if the price is lowered, you would expect more people to buy more quantities of frozen pizza. And if the price was reduced even further, say to 50 cents per box, or even free at $0, you would expect a higher quantity of frozen pizzas being sold. On the contrary, if the price of frozen pizza was offered at $30 a box, there'd be significantly less quantities of frozen pizza being sold, especially if competitors are offering the pizza at a much lower price. And this is the law of demand. I think this concept seems to parallel the great economist Adam Smith's narrative of the invisible hand and how an economic society operates. We can visualize this scenario conceptually in the stock market by assuming that if we are willing and able to buy $10,000 worth of PharmaCorp stock and the price of the stock was $5 per share, well, in order to buy $10,000 worth of stock, we would have to acquire 2,000 shares of stock, right? But let's assume that the price quickly falls to $4 per share. Now that the stock price has abated to a lesser value, according to the law of demand, quantity demanded will increase because my quantity of shares required at a total of $10,000 will increase. I need to acquire more shares to satisfy the amount that I was willing and able to purchase PharmaCorp stocks. Since the new share price is $4, I would need to acquire an additional 500 shares of stock for a total of 2,500 shares, as opposed to the 2,000 shares when the price was $5 per share. Again, economists call this inverse relationship the law of demand. As the price decreases, however, you need to be careful when applying this concept to stocks because sometimes a stock may present the illusion that it is a great buying opportunity, but the stock could potentially fall even further. You have to ask yourself, why is the stock price heading lower? What is the financial condition of the company? And are they headed for bankruptcy? There are so many factors involved, which we will cover throughout the series, that explain the causes for a falling stock price. A change in quantity demanded is a movement from one data point on the line to another. Essentially, when the price of the stock changes, this will move the quantity demanded along the demand curve. The example that I provided earlier describing the law of demand and $10,000 worth of PharmaCorp stock is a prime example of a change in quantity demanded. Price changes quantity demanded, but you might ask, what or who changes the price of a stock? In the stock market makers have the ability to alter the buy or sell quotations, but it's the market, the buyers and sellers who ultimately dictate the price of a stock when they decide to place a transaction based on the quotes provided by market makers. And we'll come back to this subject when I talk about market equilibrium near the end of this section. Now that we've covered some of the essential components of demand, it's time I introduce one of the most critical concepts of this section, and that is demand shifters. Understanding supply and demand shifters in conjunction with market equilibrium is what has enabled me to anticipate the outcome of the future price of most financial securities. It's an important topic, so you really need to pay attention. Just as there lies confusion between the terms demand and quantity demanded, there also lies confusion surrounding the terms a change in demand and a change in quantity demanded. Remember, a change in quantity demanded is a price movement along the demand curve. A change in demand means that every value within the demand schedule will change. So you basically disregard all of these values and replace them with an entirely new set of values for a new demand schedule. And so what this does to our supply and demand graph is that it shifts the entire demand curve either to the left or to the right. Any positive effect will shift the entire demand curve to the right, and any negative effect will shift the entire demand curve to the left. So What constitutes a positive or negative effect? Now, in economics, you learn that there are generally 5 determinants which shift the entire demand curve. The first is taste or preferences. This determinant will shift the entire demand curve based on the tastes or preferences of a particular stock. For example, if our drug company just released positive news that they had just cured cancer, well, investors would find this to be very favorable, and so our demand curve will shift to the right because it is a positive effect. Investors and traders will dedicate preferential interest in the company, thus shifting the curve to the right. However, if the company was found engaging in illegal activity or misrepresenting the facts of their business operations, this would leave a bitter taste in the mouths of investors, and so the result of this negative effect is a demand shift to the left. The second demand shifter is the number of buyers. If there is an increase in the number of buyers, in this case traders or investors who look to acquire shares of PharmaCorp stock, this will shift the demand curve to the right. But if there is a decrease in buyers because maybe there is uncertainty in the market or investors or traders are on vacation for the holidays, this will evidently decrease demand, which will cause a shift in the demand curve to the left. The third determinant is the price of related goods or the price of related stocks. A change in the price of a related stock will alter the demand for that stock, depending on whether or not the stock is a substitute or a complement. So, what is substitution? Let's assume that you have very similar tech companies that offer shares to the public. If one company has a higher price or might be perceived as an overvalued asset, the lesser or undervalued company might seem like a more attractive investment. Or perhaps you have competing firms within the same sector. Company B is profitably deficient and possibly heading towards bankruptcy, while Company A is outperforming the other stocks within the sector. So investors and traders might gravitate to Company A because it is outperforming Company B. So demand would increase for Company A, which would shift the demand curve to the right, and demand for Company B would shift to the left, since there might be less demand for the company that is underperforming or headed towards bankruptcy. Another example is that some argue that airline stocks can be affected by oil prices, since the operating expenses for airline companies are heavily weighted by the cost of fuel. So as oil prices drive down fuel prices, this would benefit airline stocks. So you might sell oil and buy stock for airline companies through a process of substitution. Complementary stocks are pretty self-evident. They are stocks that complement one another or they are somehow interrelated with each other. Let me illustrate with a simple analogy. If a tech company produces microchips primarily for another tech company that manufactures computers, these two companies would be complementary to each other. Or if the demand of oil companies rise, this could initiate a ripple effect that would inadvertently increase the demand in other stocks within the same sector or industry, so demand for most of the companies will increase, and the underlying result is a demand curve shifting to the right. Additionally, if demand for one company or industry were subdued by some cataclysmic event or unpredictable phenomenon, this would spontaneously induce a lot of distress to the majority of companies that fall within the confines of that particular industry or sector, thus resulting in a demand shift to the left. This is closely paralleled to a financial term known as systemic risk, not to be confused with systematic risk. So basically, if stocks in similar industries rise, their demand will increase in tandem with each other, or vice versa if the demand falls. In economics, the income demand shifter refers to income that is generated through your job or business income, and it states that a rise in income will cause an increase in demand for a particular product. Conversely, as your income falls, so too does the demand for such products. But the income demand shifter, when applied to stocks, is strictly related to the amount of capital you have at your disposal to purchase stocks and should not be associated with other sources of income. So as your trading capital rises, this will enable you to acquire more shares of stock. Therefore, you would be causing an increase in demand, shifting the curve to the right. The same is true if you incur a significant loss and your trading capital is reduced. you would generally and should acquire a lesser quantity of shares, which would decrease demand and shift the curve to the left. One thing you should never do as an investor or trader is when you lose money, you try to make up for it by acquiring a large amount of shares to make back your money. This is what we call revenge trading, and it is an easy method to lose all your money. So don't do it. Finally, the last determinant of demand is buyer expectations. If the financial outlook of a stock looks promising in the near future, investors or traders may purchase shares now in order to beat the anticipated increase in stock price, which would ultimately increase demand. Or if subsequent expectations are cynical, then this will decrease demand, shifting the curve to the left. So as the expectations of the trader or investor change with respect to a particular company, this will change or shift the demand curve depending on whether the expectations are optimistic or pessimistic. Since we've already covered some of the principles of demand and understanding the concepts, I'm going to run through the supply aspect fairly quickly because it closely reflects demand, except now, instead of taking the role as the buyer, we are looking at the scenario from the perspective of the seller. To make it simple, when we talk about supply, we're referring to the suppliers, or in the stock market example, sellers. Think of supply as being that the sellers are supplying stock to the buyers. Supply tells us who is willing and able to sell various quantities of stock that will be supplied at various possible prices. And just like before, this information is reflected in the graph by drawing a supply curve or through drawing a supply schedule. Again, quantity supplied should not be confused with supply, just as I stated with our explanation regarding demand. Quantity supplied is a specific quantity of stocks being sold at a specific time period. I generally use daily intervals for my charts, but you can apply any time frame you desire. Now, the law of supply is the exact opposite of the law of demand. The law of demand was an inverse relationship between price and quantity demanded, but the law of supply states that there is a direct relationship between supply and quantity supplied. Inverse simply means that when one goes up, the other goes down, or when one goes down, the other variable goes up. But with our direct relationship, this implies that as the price increases, so too does quantity supplied. Or when prices decline, quantity supplied will also decline. We can demonstrate with an unpretentious thought experiment. If you're selling any product or service, if the price increases, you'd want to sell more quantities of that product or service, right? Because this would entail more money in your pockets. But as the price falls, you would be inclined to sell less because that would allude to smaller profit margins. And if the price fell too low, you wouldn't be able to sustain a cost-effective strategy to keep your company profitable. This is the law of supply. Changes in quantity supplied are evoked by a change in price. If we look at the supply schedule and select one data point, let's say $2 at a quantity supplied of 8,000 shares, that would represent this coordinate on the graph. Now, if we select another point, let's say $4 at a quantity of 16,000, that would be this data point right here. So when the price changed from $2 to $4 and quantity supplied from 8,000 to 16,000, we say that there was a change in quantity supplied. It's simply a specific data point on the supply curve that is moved from one data point to another. We also need to provide a time frame, so we'll make it a monthly period. Just as a reminder, a change in supply is not the same as a change in quantity supplied, which we discussed just a moment ago. A change in supply means that every value within the supply schedule changes, and this will shift our supply curve either to the left or to the right. So, some of the determinants that will shift the supply curve are defined by supply shifters. When we talk about supply shifters, we're expressing a direct cause and effect relationship between certain events, which we classify as determinants, and how they will affect a shareholder's decision to sell their shares. The first supply shifter is technology. Throughout most of our history, stock transactions were executed at physical locations or stock exchanges by the direction of a stockbroker. With the improvement of technology, stock transactions were being conducted with the assistance of telephones, which has been succeeded by computers and the internet. Through these technological advancements, the cost of commission fees has been significantly reduced, and this aided the growth of the number of shares being traded on the stock market. Now, I guess you could argue that technological developments helped increase not only supply, but also demand. When improvements are made in technology, this should reduce the cost for buyers and sellers, which would shift demand and supply curves to the right. If there was a sudden rise in cost for whatever reason, you would probably see less buying and selling on the market, which would result in a demand or supply shift to the left. The second determinant is the price of other goods. This idea is similar to substitution in our determinants of demand. Let's say you currently own shares of PharmaCorp stock, but there's a company called Biotech Corp, and you find that the stock to be more appealing than PharmaCorp. You might make the decision to sell your current shares of PharmaCorp stock and acquire Biotech Corp stock. These actions will increase the supply of PharmaCorp stock, and this will create a shift in the supply curve to the right, and will also increase demand for Biotech Corp, which will shift the demand curve to the right as well, because when you buy Biotech Corp stock, this will increase demand. But if PharmaCorp stock looks promising, you might decide to refrain from selling because the shares have a positive perceived value at the current moment. So the supply curve may shift to the left due to a reduction in selling. Now, this supply shifter is very important. Number of producers or sellers is mutually related to the number of buyers in the determinants of demand. To qualify as a producer or seller, you need to currently possess shares of stock. In this example, PharmaCorp stock. When consumers make purchases, they usually don't have the intent to or obligation to resell these purchases. For instance, when you buy bananas or ice cream or alcohol as a consumer, you won't resell these items back to the market. In economics, this determinant is normally applied to consumers, but in the stock market, it's a little different. When you buy stock, you usually have the intention at some point in the future to sell the shares to a willing participant or participants. So what's happening is that as buyers accumulate shares, the demand curve gets shifted to the right as more buyers demand stock. But if they decide to sell, supply is being dumped back onto the market, and so the supply curve shifts to the right. Essentially, as more sellers enter the market, there are more shares being supplied, and this will shift the supply curve to the right. When there are fewer sellers on the market, there is a smaller quantity of supply, so the curve is shifted to the left. And this is what has triggered one of the largest catastrophes in financial history, the crash of the stock market in October of 1929. There are some contentious opinions surrounding the causes for the crash of the stock market in 1929 from varying economic fields ranging from new classical macroeconomists, Keynesians, and institutional economists arguing from a demand-driven perspective to monetarists providing their own theories or hypotheses. But my view is a little more unique, and it's based on a more naturalist perspective that I devised when I was studying the foundations of penny stock fraud and manipulation. The crash of the stock market in 1929 was actually driven by nothing more than two primitive emotions, namely greed and fear, in conjunction with an element of market manipulation. In order to understand my perspective, you need to understand what was happening in the stock market during this period. Many wealthy investors had exemplified the false promise of everlasting prosperity to the American people. Americans had called it the New Era. Some investors had encouraged everyone to buy stocks because this was the path to prosperity. And so people from grocers to newspaper delivery boys were purchasing shares of stock from one company or another. The stock market was attracting a lot of fresh, inexperienced speculators that knew nothing about how the stock market operates. All they saw were the dollar signs and how a small minority was getting wealthy through the stock market. And this led people to believe that it was easy to make money in the stock market. What this did was that it had increased demand beyond any rational level, so the demand curve gets thrown to the right. And when I talk about market equilibrium later in this section, you'll see that this excessive demand had drove the price of stocks much higher. This form of fraudulent activity is called a pump and dump. It's when investors acquire shares of stock and then they find ways to entice other speculators or other gullible participants into buying the stock, whether through misrepresentation or convincing people that this stock could make them filthy rich, or any other malicious tactic simply for the sake of increasing demand, which artificially inflates the price of the stock. The early investors will then sell their shares for a substantial profit when the price of the stock has risen to an astronomical amount, while the unsuspecting buyers continue to buy. When the early buyers quote unquote dump their shares, this causes a massive shift of the supply curve far to the right, as our determinant, the number of sellers, will force the price of the stock to be significantly reduced. And all of the susceptible quote unquote suckers who bought the stock thinking that they would get rich off of it got left with nothing but worthless stock. Now, these pump and dump schemes are pervasive and they occur on a regular basis in penny stocks. It happens all the time. If you visit the SEC's website, there are people constantly being arrested for stock manipulation and coordinating pump and dump schemes to artificially inflate the price of penny stocks. These are just the people who got caught, not including the numerous manipulators who get away. Today, this sort of practice is illegal, but prior to the Great Depression and Black Tuesday, pump and dump schemes were completely legal. Stocks were manipulated on a regular basis. A small pool of wealthy investors had attempted various deceptive strategies to attract new, credulous investors. Sometimes they would contact the press to write positive news stories in hopes that small investors would be influenced and buy stock for a company. Now today, penny stocks are often hyped by stock promoters who give a company press and make false promises such as this company will be the next Microsoft. And so this generates demand, much like what was happening during the early 1900s. What was really happening behind the scenes was that the smart money and the wealthy individuals were selling their shares of stock while everybody else was buying. And given the magnitude of shares held by the wealthy, this commencement of supply had caused the stock price to collapse. And when the small investors witness the stock prices crashing, these sellers start to panic, which causes an avalanche of supply, which pushes the price of the stocks even lower. This is why the Dow Jones tumbled by about 50% in such a short period. Now, I've been studying penny stocks and microcaps for many years, and one of my observations is that the same irrational behaviors pervading all of the unsuspecting penny stock traders that get lured into buying useless shares is exactly the same attitude that was present among many Americans in the early 1900s that had lost fortunes due to the stock market crash. It wasn't until several years later, when the Securities Exchange Act of 1934 had been enacted to prohibit stock manipulation and pump and dump type structures. So the crash of 1929 was nothing more than a highly orchestrated pump and dump scheme that I've suggested is the biggest pump and dump scheme in the history of the stock market. It was caused by a large portion of Americans being subjected to two very distinct emotional inclinations, which was greed and fear. Greed causes insatiable craving to make more money and accumulate more shares, and all this did was increase demand and artificially inflate the price of the stocks, thus making Americans much wealthier, or at least made the illusion that Americans were getting wealthier. But sadly, people today still fail to recognize these same patterns and signals that were apparent during the early 1900s. They engage in the same behaviors, compelled by hope, extreme optimism, and fueled by greed and a desire to become instantly wealthy, just as we've seen throughout our financial history and will continue to experience in the future. So I guess it's nature's way of saying stop being greedy. I know I went on a rabbit trail there, but you need to be careful when there is a substantial demand, because it could be followed by an influx of supply, which would shift the supply curve far to the right, just like what happened with the crash of 1929, tulip mania, the dot-com boom and bust, as well as countless penny stock companies. And the way I look at it is that present-day stockholders translate to future sellers. The question isn't, will people sell their shares in the future? The appropriate question is, when will they sell their shares? This determinant in economics is generally identified as taxes and subsidies, but since stocks are not eligible for subsidies, I just label it taxes. In the United States and many countries around the world that impose taxes have a very complicated structure. I bring this to your attention because these taxes can affect dividend policies for companies. Some long-term investors will favor stocks that offer high dividend payouts, while others might favor low payout dividend stocks, which are sometimes related to tax advantages. This can shift both supply and demand curves. Now I can get into greater detail about the clientele effect, which states that investors will respond to a change in company policy by amending their portion of shares within the company, but this is beyond the scope of this video. For most stock traders, taxes bear a minimal influence on a trader's decision to place trades. Investors, however, will react to these policy changes by adjusting their quantity of shares being held. And depending on the policy change, the supply curve can shift left or to the right. Again, given the complicated nature of taxes, you should try to keep it simple by asking yourself, if the change in company policy benefits the shareholder, how will this cause a shift in the supply curve? Well, the supply curve will shift to the left because current shareholders will hold on to their shares so there would be a reduction in shares being sold. If the company policy had an adverse effect on shareholders, this would shift the supply curve to the right because shareholders would be selling their shares. For some companies, another supply issue involving taxes occurs at the end of the year. In order to claim a tax loss on your stocks, you must sell these stocks by December 31st, so there is usually a greater quantity of supply or selling on the market near the end of the year for tax purposes, so our supply curve may get shifted to the right. Of course, a lot of these stocks may be blue chip stocks and not so much penny stocks, so this tax effect might not be applicable to many penny stock traders. Changes in future expectations from the perspective of the seller will shift the supply curve. If sellers anticipate the stock price to go higher for whatever reason, sellers will refrain from selling their shares because they anticipate the price will rise, and this will produce a greater return, and investors and traders obviously want to maximize profitability. So the supply curve may shift to the left because there would be a decrease in supply of stock on the market. In contrast, if shareholders expect the price to decline in the future, or if there is panic selling and stock prices continue to fall, which does happen a lot in the stock market, this will increase the amount of supply available, and so the supply curve is shifted to the right. Now that we've covered supply and demand, I'm going to show you how we can unify those concepts to help predict the movement of any stock price and help you understand why a stock price is moving through something called market equilibrium, also known as the market clearing price. The equilibrium price is when quantity supplied is equal to quantity demanded. It's when buyers demanding stock and sellers attempting to sell stock come to a mutual agreement regarding the price of the asset. It's like if you're negotiating the price of a new car at the dealership, the seller might be seeking a selling price to maximize their profits, but at the same time, the buyer is looking for the lowest possible price, and when both parties can form a mutual agreement on the price, the transaction takes place. And this is exactly how the stock market operates. When the market clearing price or market equilibrium is met, a stock transaction will execute. This is the price that we see displayed at stock exchanges, on the internet or any device that reveals the current price of any stock. Here's a supply and demand graph, just like the one we saw near the beginning of this section. It's essentially a demand graph and a supply graph combined. What's different about this chart is that the x-axis, this horizontal axis down here, where the quantity supplied or quantity demanded was labeled, has now been changed to denote volume. The horizontal axis now measures both quantity demanded and quantity supplied, and this is where the market is in equilibrium or quote-unquote in balance. We also can't forget to create a specific time period for this chart, so we'll go ahead and assign a time frame, say on a monthly basis. So our equilibrium price, or simply the price of the stock, is at $3, and our volume is 60,000 shares of stock for the current month. Now, it's time to incorporate the determinants of supply and demand with our market equilibrium to demonstrate how these shifts in both the supply and demand curves will affect the price of the stock. I'm going to quickly illustrate by picking random supply and demand shifters that we discussed earlier. The first demand shifter we discussed was taste and preferences. I gave an example about PharmaCorp stock releasing positive news that they had just cured cancer. Well, investors would find this to be very favorable, and so our demand curve will shift to the right because it is a positive effect. Now watch what happens to the equilibrium price when the demand curve gets shifted to the right. As the demand curve is shifted to the right, the equilibrium price now rises because quantity demanded and quantity supplied are now equal at $4. This is because demand was increasing, and this increased the price of the stock. Of course, in real life, if a drug company found the cure for cancer, the stock price would be much higher than $1. But anyways, notice how the demand curve appears to move upward, but this is just an illusion, and it's kind of confusing for people who've never studied economics before. The curve isn't rising at all. It just presents the illusion because it's moving against an upward sloping line. And the same is true when there is a decrease in demand. As the demand curve is shifted to the left, the demand curve appears to be falling, when in fact it's just moving to the left. And we can see what happens to the price of the stock when demand is reduced. The price starts to fall. Another demand shifter we talked about was buyer expectations. If the financial outlook of a stock looks promising in the near future, Investors or traders may purchase shares now in order to beat the anticipated increase in stock price, which would ultimately increase demand. Or if future expectations look negative, then this will decrease demand, shifting the curve to the left. We can see what happens to the price of the stock as the demand curve is shifted to the left. The equilibrium price starts to fall. So as the expectations of the trader or investor change with respect to a particular company, this will shift the demand curve depending on whether the expectations are optimistic or pessimistic. For supply, there is the number of sellers supply shifter, which states that as more sellers enter the market, there are more shares being supplied, and this will shift the supply curve to the right. When there are fewer sellers on the market, there is a smaller quantity of supply, so the curve is shifted to the left. When the supply curve is shifted to the right, as more shares are being sold, we can see that the price of the stock begins to fall. A couple of examples with cases involving unprecedented quantities of supply was during the 1929 stock market crash and the bust of the dot-com bubble. I think there are many determinants for supply and demand that aren't listed, such as human emotion. Greed creates demand and fear causes supply. So in the event of heightened fear for a particular stock, you can expect current shareholders to sell their shares, and this will increase the supply. So the supply curve will shift to the right, and we can see how this affects the stock price. As the curve moves to the right, the price will decline. So the general rule of thumb is that when the demand curve is shifted to the right, the stock price starts to rise. Or when the supply curve shifts to the left, the price of the stock will rise. And when the demand curve is shifted to the left, the price of the stock falls. And when the supply curve is shifted to the right, the price will fall. And this is how I generally anticipate the price of the stock if and when certain financial conditions or determinants are occurring or might occur in the near future. One of the problems with this economic model of supply and demand is that, like almost everything in economics, it's all theoretical. There is always one assumption being made when there is a shift in either curve, and that is other things being equal, also known as ceteris paribus. I know it kind of sounds like words from a Harry Potter spell, but it's a Latin term that delineates all variables are assumed to remain constant. So, for example, if there is an increase in demand because preferences for a stock were favorable among investors, you assume that future expectations, demand for complementary stocks, the income determinant, or any other determinant are not being taken into consideration. But in the real world, this doesn't happen because almost all determinants are occurring simultaneously. So, investors' income might increase, which would shift the demand curve to the right, but then the demand would also shift to the left because investors are substituting the stock for a better performing stock, and future expectations look bleak, so the supply curve is shifting, and all of these events are happening at the same time. So again, the assumption being made is that everything else remains constant, which doesn't seem to truly depict the exact value of our stock price by implementing this model. And I sat down one day and tried to construct a solution to this problem, and what I came up with isn't feasible 100% of the time, but it's more effective than assuming ceteris paribus. And so what I came up with is that I try to analyze which determinants holds the most significance at the present moment. So if incomes are rising, expectations are changing, but then if a terrorist attack wiped out half of the state of New York, the most significant determinant might be fear or an increase in the number of sellers, which would shift the supply curve to the right, causing a massive decrease in the price of stocks because that determinant would outweigh all the others. There is one last topic we need to cover before we finalize this section. It's a term which introduces a situation when our economic model becomes unbalanced, or more precisely, when supply and demand are in a state of disequilibrium. When market makers adjust the ask price above equilibrium, this infers that quantity supplied exceeds quantity demanded, which in economics is sometimes attributed to the terms glut or a surplus. This is when quantity demanded and quantity supplied are no longer in equilibrium. In the financial markets, the ask is the minimum price that sellers are willing and able to sell at. In a hypothetical scenario, the way a stock will reach disequilibrium is when market makers adjust the price of the quotes. In this example, they raise the ask price to $4. Looking at our graph, the demand curve will tell us that at a price of $4, only 40,000 shares will be bought. However, 80,000 shares are willing to be sold at that price from sellers. Notice how I excluded able from willing and able because willingness alone is not effective in a competitively driven market. With an equilibrium price set at $3 and market makers setting the ask price of $4, this encourages 80,000 shares to be sold by sellers, but discourages many buyers from buying at such a high price. As you can see, the problem is that it created this disparity between buyers and sellers. And so market makers need to lower the ask price closer to the bid if they want the stock transactions to take place. So if nobody is placing stock transactions, then market makers aren't getting paid. So they are forcing to bring the bid and ask price closer to the market equilibrium. Think of it as a fast food retailer offering a hamburger at $50. Many fast food retailers would love the idea of selling a burger at $50 a piece, but I probably won't be able to sell at that price because consumers are not willing or able to buy at that price. So as a consequence, I would have to lower the price of my burger if I wanted to sell any. So what happens when the market maker set the price of the bid far below the equilibrium price? Any price set below the equilibrium price means that quantity demanded now exceeds quantity supplied, which is what we call a shortage, as we can see here. The quantity demanded is exceeding the market equilibrium. The price that is usually set below the equilibrium price by market makers is our bid. And the bid is the maximum price that buyers are willing and able to buy at. In this extreme scenario, if market equilibrium price is set at $3, but market makers set the price of the bid to $2, we look at the corresponding quantity supplied at $2, as well as the quantity demanded at $2. And again, this creates disparity between buyers and sellers. Sellers are willing to supply only 40,000 shares at $2, but buyers are willing to acquire 80,000 shares at that price. So, with our hamburger example, if the fast food retailer offered a hamburger at 25 cents, I might be willing to buy at 25 cents, but I probably won't be able to buy at 25 cents because the restaurant is not willing or able to sell the hamburger at that price. They aren't willing because they know other buyers would pay more for the hamburger, and the fast food retailer won't be able to sell at that price because they would be losing money rather than generating a profit. So market makers would have to raise the bid price closer to the equilibrium price to satisfy the interest between buyers and sellers. And trust me when I say this, market makers want stock transactions to take place because they generally get paid through something called the market maker spread, which is just the difference between the bid and ask price posted by the market maker. When there isn't any activity between buyers and sellers, market makers aren't getting paid from the spread. And so market makers will have to adjust the bid and ask price accordingly to prompt the facilitation of stocks within the stock market.